Good evening, everybody, and welcome to the October session of the Investing Roundtable. This is a long-running feature sponsored by the Mid-Michigan chapter and Manifest Investing. We're well into our 16th year. In fact, we'll be celebrating our anniversary fairly soon. And tonight we still have 3 of our original 4 nights that have been with us since the beginning. Cy Lynch from the Atlanta area. Cy is the former chair of the NAIC board. He's a longtime volunteer, and he's working right now as a pastor in a church in Atlanta. He's been doing that for, I don't know, Si, about half dozen years now. Is that about right, you think?
Actually going on 8 in February.
My goodness, the time really moves quickly, doesn't it? Okay. My good friend Mark Robertson, who's also a director on the Mid-Michigan chapter, is from Rochester Hills, Michigan, about 40 miles south of where I live. And Mark and I have been putting these things on the air now together. I don't think either one of us have missed more than maybe 1 or 2 in the entire time that we've been dealing with these things. Mark, glad to have you with us again tonight.
Yeah, I'd like to make it clear that the image is in no way reflective of the condition of our portfolio. And just blue and happy Halloween.
That's Pumbaa. If you're trying to figure out what the heck Mark is dressed as, and that's an actual photo. That's not anything photoshopped. He actually got into that thing. Tell him what you're going to do on Friday then, Mark, with all your family.
Well, we have a brand new grand puppy. He's a golden doodle, and he's just a sweetheart. But his name is Leo, and our entire family is dressing up as Lion King. So I nabbed the role of Pumbaa. And we'll have some fun.
So we're glad to welcome you all here tonight, and let's get started. We'll get the disclaimer out of the way real quickly. Everything we do on the roundtable, and we do mention real stocks in real time, but it's being done for educational purposes only. It's a demonstration of what you can do in putting together a stock study. We don't recommend any stocks. We ask you to do your own homework, draw your own conclusions. We might own some of these securities, and we'll talk about it. If we do own them, we'll try to inform you about that. If you'd like a copy of our slides, then send Mark an email or send me an email. Those are our addresses at the bottom of the slide, the blue links that are right there. And if you'd like to be added to our guest list, the URL directly above Mark's email that starts betterinvesting.org, that URL will take you to the Mid-Michigan chapter. When you get there, if you scroll down just a little bit, you'll find a box where you can subscribe to our guest list. And once you're on your guest list, then once a month, my wife, who is in charge of that list, will send you a reminder of the roundtable and a way that you can register with a link right there without having to search for one anywhere else. So if you're not on our list, please put yourself on the list, and we'll make sure you get a monthly mailing to remind you. Our performance has been, this market has been wonderfully wild. The ride at 20% plus has been going on now for close to 2 years. And trying to keep up with a market like that with a portfolio that you manage once a month is a very, very difficult task. And you can see that we're still beating the market. The market zero down there is being at the market, the benchmark. We use the Wilshire 5000, and you can see that our blue dots are still riding above that green line, but they're not nearly where we'd like them to be. I think right now our performance is 1.7% better than the market, and that's over the entire almost 16 years now of the portfolio. You get that relative return by looking at our rate of return, which is 16.1%, and that's a wonderful rate of return for a 15 plus 15-year plus portfolio. We compare it to the Wilshire 5000, which has been chugging along at 14.4%. Do a simple subtraction and you get the 1.7 where you beat. We're trying to outperform the market with 55% or better of our picks. We'd like 55% of our picks to do better than the market, to make money, in other words. And we had gotten up to 54 point something or other about 4 months ago, but we've kind of backed off a little bit to about 43 or 44% right now. We have a whole boatload of our picks that are losing a small amount of money, and it's kind of mirroring the fact that the Russell 2000 is having a little bit more difficulty maintaining the heights that some of the other things in the market are doing at the moment. We're not unhappy about anything that can beat the market. And we feel that even if you beat the market by as little as 0.5%, you should be celebrating that. We have discovered that the goal of beating the market by 5 points is an extremely aggressive goal. And if you can do it, more power to you. But beating the market at all is something that you should be celebrating if your club's able to do that, especially if it can do that over a reasonable length of time. That's enough about this particular slide, unless you have something to add, Mark.
Well, I think just to give some powerful context, that +5 dotted line across the top there, we track a whole bunch of the best exchange traded funds and traditional mutual funds. About 650 of them, 20, that's 20 of them are at +5 or more. So that's 20 out of 650. So that gives you some idea of how lofty that objective actually is. And Nicholson knew that. He warned us about that. And, but frankly, I was kind of enjoying being up there close to 8% plus 8%. So it'd be kind of nice to go back.
Well, I hate to say it, but we need the market to cool down a little bit so we can run the race without the finish line keep moving faster than we're running, you know?
Yeah, the Wilshire 5000 is a pretty tough benchmark.
Yep. Here's our portfolio, or at least the first 20 or so holdings in the portfolio, and it's sorted from the highest value in the portfolio, and then it moves down from there. The Microsoft holding represents a 5-time pick of Microsoft over the years, and that means $5,000 has gone into the portfolio, and yesterday it was worth 134,000 plus for this entire portfolio. Sometimes we show you a slide that shows that our Microsoft holding alone balances out every single loss in the entire tracking portfolio. Folks, please don't get the idea that a portfolio of 150 or 170 stocks is something that you should be aiming for. This is a tracking portfolio meant to show you how our picks have been doing over the time that we've chosen them, and showing it to you on a regular basis so that you can see that you can, in fact, beat the market. My part tonight, and that means the average stock in the Manifest Investing database, is expected to return somewhere a little bit less than 9%. You can see that 8.7 over there on the right-hand side of the slide, and that's an average. Nicholson said we should be aiming, our goal would be to beat the market by 5 points, and he made it extremely clear that beating the market by more than 10 points was a very, very almost impossible task. So we set the sweet spot as 5 to 10 points above the average. That's where that 13.7 to 18.7 comes from. And then we measure the anticipated values, the potential values of the entire tracking portfolio. We give it a weighted average based on the different pars, and that weighted average tonight is 10.3. where we get the value of how we're doing potentially into the future. We'd love to see that par value for this portfolio move up into the 13, 14, 15 range. But beating the market again is a feat in and of itself. The portfolio exhibits excellent quality ratings at 85 plus, and the growth is pretty decent at 11.5% sales growth, although in the studies that we've been doing about successful mutual funds and ETFs, we've kind of come to the conclusion that you really need about 12.5, 13, maybe even 13.5% sales growth if you're going to hit that beat the market by 5 points goal. So we'd love to increase our growth if we could and our par if we can. And that's the kind of stocks that we add to the roundtable portfolio then. We're in the midst, we've kind of taken a time out to work on our small company list that we're going to present to the public on Saturday morning. But as soon as we get that out and published, we're going to go back and keep doing a little bit of culling in the roundtable tracking portfolio because over the 15 plus years, stocks that perhaps were doing extremely well are not doing as well as they used to, and there's always room to freeze some of these positions that we no longer think are positions that are going to help the portfolio going forward. Mark, what else do you want to add to this slide before we continue?
I see one that's fairly important to talk about. This one here has been on a tear. Advanced Micro Devices, AMD is the ticker. I'm not sure how much it's up, but the amount that it's gone up in price has driven the par to a negative number. Now, this is probably this is a corollary to Nicholson's advice for if you've got a company that's got a double digit, especially a fairly high double digit growth rate, you give it some room to breathe. And what I think we see happening here, and Ken, correct me if I'm wrong, because I know you're very, very close to this company. I think the analysts haven't caught up with whatever the reason for the tremendous thrust in stock price is. Am I anywhere near?
I think you've hit the nail right on the head, Mark. Advanced Micro Devices is a very difficult company to study on a traditional stock selection guide. It's a semiconductor company. It's highly cyclical in a lot of ways. And there's a wide range of opinions on what sales growth and earnings per share growth would be going into the future. There's also a wide range of opinions on what PE values should be for this particular company. I think you're right that the company surprised to the upside with such really good numbers that the analysts were kind of caught a little bit flat-footed, and they have to rethink, and it takes them sometimes as much as a month or 6 weeks to rethink their models and to come up with a new model that might reflect what's happening in the most recent past. So don't rush out to sell something just because the par goes negative, especially when the sales growth is double digits, as Mark pointed out.
Yep, give them some forgiveness anyhow. All right, well, there is the round table, the actual round table. And I thought we would just share this one.
The tourist version of the round table, right?
I thought we'd share this one. This is just an example of a series of slides we had put together for the Georgia Investor Fair, I believe, Si. And
Yes.
I just thought it's kind of fun. How many years ago was this?
That I bought Home Depot in 1984.
Wow.
For the first time.
So very close to the IPO.
It would have been probably within 3 years or so. When I bought it, they had 12 companies. 12, I'm sorry, not 12 companies, 12 stores.
12 stores.
Yes.
Wow. Well, it's a powerful message.
You have half that many just within 10 miles of me, Mark. You know?
I know it. We've got at least 4 within a
Yeah.
fairly short drive right now. But I mean,
Yeah.
that one share through all the splits, and I assure the audience, he's not going to tell you how many he has, but he bought more than one share. Hold through all the splits and everything, you'd have shares worth $704, a single share. And that single share would actually be paying you almost the original price, the original cost in dividends per year. So good, clean fun. And so, Cy, your mission tonight is to help us find the next Home Depot.
The next Home Depot. All right.
Well, maybe for next month, because
Yeah, because I was going to say, being a teaser, we're probably, well, it's a loaded comment, but we may be moving toward the next Cognizant. So
there you go.
when we get to that part,
I'm not taking the bait. Go ahead.
Well, here we are. Here we are, Cy. Take it away.
Here we are with Gentex, and the reason I made that comment is that if you look at the top of the roundtable portfolio that shows how many times everything's selected, I think Gentex is second to Cognizant, and this will be getting it close to tying with Cognizant. Yeah, there you go, Mark. You had it, and I had the abbreviation of it. So on my slide. And I do own Cognizant myself. So in two of our my portfolio, my wife's as well. So just give you that disclaimer. And here you could see the history on Gentex. It's a community favorite. So we'll go through the slides pretty quickly, just kind of giving you some updates on the company. You see Value Line gives it a pretty wide range of a 3 to 5 year price target, but certainly some great potential there, and even some good near term. And I believe Value Line even upgraded it from a 3, a neutral for timeliness, to a 2. So it, at least according to Value Line, and I think pretty much with my study, as you will see, and manifest consensus, it's got both potential near term as well as long term potential. Next slide. I just thought I would take a look this month at repeating the portfolio so that we don't turn 125 stocks into 126 or whatever it works with. And again, chasing Cognizant with the repeats. And here is the portfolio ranked by par, and you see that Gentex is a bit into the yellow there and has good high quality, along with a few other good quality, excellent quality companies in this list. Next slide. Here's the auto parts industry ranked by quality. Gentex is right up there with excellent quality companies, at least those top 5 that you have, and is well up there in the potential return. Next slide. Just for fun, I went with the discretionary industry as well, because I think there's some opportunity in both I said industry sector, discretionary sector, as well as the auto parts industry, because of just uncertainty in the market generally, uncertainty in economic outlook, both domestically and internationally, and again, perhaps in the auto industry as well, as we'll talk a little bit about in the specific slides that are coming up. And again, you see that Gentex in discretionary, ranked by quality, is among the highest potential returns for those excellent, super excellent quality companies that you see on this slide. Next slide. Just a verbal summary of the company. In a word, Gentex, historically, their business is automatic dimming mirrors, and they're seeking to expand that core technology, that core competency, into other both related and unrelated areas. You see that the automatic dimming mirrors are 98% of their 2024 revenues, and that doesn't change too much for 2025, although they did make an acquisition that will shift that a few percentage points, but not a whole lot. But again, they're seeking to grow non-mirror business as well as their mirror business. And they actually started in the smoke alarm business, which they still are expanding somewhat there, but it's now just a fraction of the business. Next slide. I'm surprised, just before we go on, that Mark and Ken didn't want to do Gentex too, because it is a Michigan home-based company.
I do own shares.
So just throw that out. Here's the company slide on who they are. I won't read it to you. You notice the markets that they're in. Again, largely automotive, with smatterings in the aerospace, fire protection, and medical areas. And those are, especially the aerospace and medical, are among areas that they hope to really expand in going forward. Next slide. Gentex has a large market share. You can see they penetrate the electronics area by about 36% for the automatic dimming mirrors. So they still see growth there in their core competency. They supply pretty much all manufacturers at some part, to some degree, and there are their top customers in Toyota, Volkswagen, and General Motors. Next slide. And again, their strategy is, as I've kind of alluded to and just talking to, expand automotive by growing their product portfolio that we'll talk some specifics in a moment, and then expanding into new industries. Again, largely right now in the aerospace and medical areas. Next slide. And here are some of their core competencies as far as skills. They've got, as you can see, a lot of patents that have been approved, over 2,000, and between 500 and 600 new patents under application that scan various technology. And really, I guess where they're concentrating a lot now is in the glass handling area and in the camera and vision area. That both of those impact the automotive that we'll see, and the airlines, and also the medical. Next slide. And here's kind of, again, another way of looking at what I mentioned, digital vision. They're integrating cameras now into both their car, their automotive mirroring and vision providing, as well as getting into the particularly, again, the medical area, which is some of that sensing, which is the number 4 that they're talking about, using cameras to sense things that are useful for medical diagnoses. Next slide. And I just mentioned integrating cameras. If you read the Morningstar report on Gentex, one of the, if you remember if you're familiar with the paid report, the Morningstar Premium report that you can either pay a subscription fee for, or many brokers have it available. One of the cons they had, or the bears say, they had the bulls say what's positive about the company and the bears on potential negative. And one of the items on the Morningstar Bear side is that cameras could replace mirrors in cars and other motor vehicles. And here's one of Gentex's answers to that, where they're integrating cameras into, you can see on the left hand picture there at the top, that's actually a camera-based display. And then the mirror. So they're working on integrating cameras into even their base core business of automotive mirrors. Next slide. And this is just another more detailed description of what they're going to and what they call the full display mirror, and who is incorporating that into their vehicles right now. Next slide. And here's some of the new technology. This was presented, well, actually, some of the slides I just mentioned was the Consumer Electronics Show, CES, that is the big technology showplace. This actually is from last year's investors presentation, but this is still what they're really working on, is a dimmable visor, just an improvement to the simple flip down visor that you have. Also looking at sunroofs, and then as I mentioned, some of the expandable mirrors. They've got a thermal energy imaging system. And if you have a relatively new car that has Gentex provided mirror, you may very well have Home Link, or some tie to your smart home. My car is now going on 5 years old, and I believe that it does have some Home Link capability in my mirror and the box that's there with the mirror. I was trying to think of it. The only link I've actually tied to is used for my garage door opener. But again, they keep expanding more and more to where you can tie it into your smart home. Next slide. And this is the acquisition I alluded to, which is Vox. Formerly was Vox International Corporation, and before that it was founded as Audio Vox. And you could see some of the name brands of audio that Vox owned and is now owned by Gentex. They had a 30% ownership, but they have now acquired all of it, and you can see that they expect between 240 and almost 300 million in revenue this year to be added by this. And they hope to leverage, at least as I can understand most of the explanation for the acquisition, they really hope to use not as much necessarily selling Vox products in the audio areas, but use it to enter new markets. As you can see, government contracting that they have, as well as some business to consumer, B2C marketing experience, where you would go through other businesses for that would then sell to the consumers. Next slide. And again, this is just a bit more mention of it. And again, Vox has some biometrics that would enter into the medical side that Gentex is trying to get into. And again, some things even in the automotive area that they think can be built on. Next slide. Here's just a little bit of the business outlook for Gentex. Their last, they reported last Friday, and these, my numbers do include that report, and they expect that 2025 will be flat to down in their own revenues, little bit up probably because of the Vox addition starting in the second quarter. But without Vox, it would probably be a little down revenues. And as you can see, their primary markets, vehicles, production, cars, and light trucks are expected to be down in both North America, and much of their products, especially their higher, more tech products, are in EV vehicles, which again have been slowed. But 2026 shows at least a little bit of recovery, they believe, in North America, and then flat in some of their other markets. Next slide. Here's just a picture of the bars are vehicles produced globally, and the blue line is Gentex's revenues. And you can see that while, as you would expect, their revenues are sensitive to vehicles sold, they are able to continue growing revenues even when vehicle production is down or flat. You notice 2017 was the all-time high for vehicle production. That's the yellow bar, and Gentex has continued to grow their revenues relatively significantly, even though the auto industry itself in units produced in vehicles has not caught back up to that amount in 2017. Next slide.
It's interesting.
And Gentex says this uncertain outlook and complexity, they believe, creates opportunities because they have been around and have been through a lot, and they can help guide their customers through that. Next slide. And again, what they continue to plan to do is to promote or launch new products in both the automotive industry as well as outside, continue to penetrate more nameplates, more auto manufacturers, and they have grown a fair bit with kind of tack-on acquisitions and partnerships, Vox being the latest, both partnership that turned into an acquisition. Next slide. And then here is their guidance as of last Friday. You can see the revenues, which is up just a little bit. You'll again see the graph in a moment. A little bit of margin improvement. Their tax rate is a little down from what Value Line was projecting. I mean, a percentage point, nothing particularly significant. But you'll see my judgments are pretty much in line with these near-term and the longer-term guidance items like the tax rate. Next slide. And here are my projections, projecting growth to continue at what it has been for the last 10 and really longer than that. Little bit of margin shrinkage. Vox in particular has a little bit of a lower margin. And again, right now with declining vehicle sales, there can be some price sensitivities and price pressure. So I am kind of leaving expenses flat or margin flat and not using the 5-year average of 22. Again, using their projected tax rate, all of that leads to $3.01 5 years from now, compared to $3.12 on manifest, and the BI median EPS projection for everyone who's done an SSG using online tools is 272, and both of those predate the release. Next slide. And then I've just used the 10-year average PEs. Near-term notice is a little bit higher for the 5 years, but again, if I'm using roughly the 10-year growth rate, I figured this is a very consistent company, as you can pretty much see with the numbers. Although more recently the PEs have been a little higher. I think, again, market rewarding consistency, as well as just the long-term trend in interest rates until recent years. The market as a whole, PEs were up, and you see that Gentex's PEs are declining a little bit in the last few years. And so I'm going to go with the 10-year average rather than the 5, of 20 for the high, 14 for a low, or a 17 average. Next slide. And here's where we get the bottom line. I'm comfortable with a potential 18 to 22% return, depending on where those PEs fall. And that's a bit under the manifest average potential return of 22, getting a little bit closer to the top of the sweet spot out of the yellow. But I think all of us are right in line with projections, and so I'm adding 1,000 in Gentex.
Thank you, Si. Okay, before Ken gets launched, just a real quick reminder that this is the slide from last year's show, where we reviewed 2024 and then made our 2025 selections. This year, we'll be taking a look at the performance of those 2025 selections and making our selections for 2026, Saturday morning at 10 a.m. The registration is right there, and it's also available on our homepage. Send me a note if you need some help with that. We will be archiving it on YouTube. Anything else you'd like to add, Ken?
No, I'm just looking forward to this show. This is always one of the most fun ones we do, Mark.
Trick or treat, return of the right stuff. All right. Speaking of the right stuff, here we go.
Well, let's talk about Corpay. Many of you maybe knew this company in prior years as FleetCor Technology, but they rebranded themselves with a brand new name a year and a half or 2 years ago, and they now go by Corpay because they're making a real concerted effort to change their business model, to expand their business model. They're still doing all the things that FleetCor used to do, but they're doing much more. They call themselves the Smarter Corporate Payments Company, and let's look about what they mean right there. Next slide, if you would, Mark. Corpay is divided into 3 basic divisions: corporate payments, and that's the old FleetCor, representing about half of the company, and still doing quite well. Vehicle payments, and we'll talk about that, and then lodging payments, and we'll talk about that as well. But these 3 different components are quite an expansion on the business model from where FleetCor used to be 2 and 3 and more years ago. Next slide. Here's the corporate payments division. It's actually gotten down to about 1/3 of the revenue now for the total company. About $150 billion in this particular part of the company, and they basically deal with many different types of customers. You see the type of customers in the maroon colored blocks. And then they like to brag about some of the high points in this particular segment of their business. They're the largest virtual card acceptance. Over 1 million vendors accept their card. It's the #1 largest MasterCard business-to-business issuer, not doing very much with the consumer, but business to business. And then foreign exchange settlements in more than 200 different countries throughout the world. FX, foreign exchange. Next slide. Here's a little bit more explanation of some of the services provided in their corporate division. Expense management is one of the primary services, and basically it's a way for businesses to reduce paperwork significantly by using a single card that does many specific types of things for the customer. Let's go to the next slide, Mark. Here's vehicle payments. This is about half of the business. And I think I misspoke myself. This is the old FleetCor business right here, vehicle payments. We used to think of FleetCor as kind of a gasoline / food / lodging card. And that's essentially what it is, although they've broken them out into their divisions a little bit differently. Vehicle payments, however, are about half of the revenue of Corpay. And again, you can see the types of customers that might use this. They have a proprietary fuel network. In other words, they have stations that provide gas and oil, and it's proprietary to join the network where you can then use your business to business card. And there's 80,000 sites throughout North America. EV charging sites is another relatively new part of this business. And then they provide all kinds of toll clearance, parking garage services. Zappay is a kind of a ride share kind of a thing, and it's also a way of renting vehicles. So you get a flavor of what vehicle payments division does. Next slide. And basically, it's a single card which you can use for all of these different types of things, including drive-through services and insurance. These are things you don't normally think of when you're talking about a vehicle card. Next slide. Third division is the smallest and the fastest growing division. It's the lodging payments division. Right now, in the last fiscal year, about 12% of revenues. You can again see the types of customers that might use the services. And they've created a network of about 45,000 hotels, a customizable network of hotels, which these different types of customers would then use while they're on the job. Next slide. Explain a little tiny bit more about what we're talking about. The discounted hotels, about 45,000 of them, are 9 out of 10 times the cheapest hotel rate in the industry for the particular geographical location you might be talking about. There's a full suite of technology solutions which help them book the hotel, pay the bills from the hotel, get the rooms in multiple different ways, and all of these bills then flow right to corporate offices without somebody having to collect receipts and fill in all kinds of forms to make it happen. Next slide. I found this a very interesting slide on their investor presentation because it shows me exactly how I might be a good Corpay customer. Say that I work for a construction company. I might use my Corpay card to pay for gas for my vehicle, and then I might go to an appropriate location to purchase materials and tools, for that matter, for whatever construction job I happen to be working on. And then I also might be able to use my Corpay card to book and pay for a hotel that would allow me to reside near the job site for a period of time. The gas bill would go to a fleet manager. The materials and tools bill would go to the planning, whoever's in charge of the site that you're actually working at, and the hotel would go to a field worker that would be charged with lodging everybody. All these bills would be coordinated and pulled together and flow right to a central system at your business, whoever is your ultimate hirer of note. And you're not collecting receipts, you're not filling out expense reports. Everything's being managed centrally, and you're getting reimbursed if in fact you need reimbursement. But if you notice, a lot of these things will not need reimbursement because you're not handling cash in any way, shape, or form to pay the bills. Next slide.
Well, I could have used this 40 years ago.
Next slide. We're looking at Corpay's own guidance now, and they're guiding us to 10% plus in organic revenue. And that organic should be underlined 2 or 3 times, because that's not the only way that this corporation grows, but about 10% organically. They're looking for EBITDA in the low to mid-teens. They're going to be putting about $1.4 billion into capital deployment, basically into buybacks, mergers and acquisitions, debt pay down, things like that. And they're looking for net income per share to rise. That's revenues, folks, to rise 15 to 20%. And they have a 10+ year history of delivering exactly that. They make a point at the bottom of the slide that these objectives are being met by less than 20 companies in the entire S&P 500 list of 500 different companies. So they're pretty lofty goals, and Corpay has been meeting those goals and exceeding them. They had these goals originally as a 5-year plan, and they met all their goals in the first 3 years of the 5-year plan. Next slide, if you would. Their capital allocation is unique. They do not pay a dividend, but they plan on growing organically 9 to 11% over the long term. They plan to be a disciplined acquirer. In their history, and the company goes back 20 years or more, they've had more than 120 accretive deals, and they're presently making deals even as we speak that will add to the bottom line of the company. And then they're doing aggressive share repurchases, but only when they feel the shares are being traded at a reasonable price. They are not setting arbitrary numbers to buy and then buying at any price. They're only buying back their shares when they feel that the price is reasonable. That kind of sounds like the way that we invest. Next slide. Their most recent venture in mergers and acquisition is to sign a $300 million deal with MasterCard. And MasterCard is going to buy 3% of the Corpay cross-border business that basically is foreign exchange across borders, like between the United States and Mexico, for example. Corpay will then become the exclusive provider of any cross-border payments that are made in the MasterCard business to any financial institutions on either side of any of these borders. What Corpay hopes to get out of this is, first of all, a realization that the cross-border business exceeds $10 billion. That's approximately the value that was paid by MasterCard for their percent of the business. It's going to be looking at more than 100 new banks in the total addressable market that they will be able to sell across the borders. In other words, new customers. And then they expect to add 2 to 3% revenue growth by dealing with these new customers, and also expanding current customers that happen to have outlets in countries other than the United States. So they're really making a big play with MasterCard here, and MasterCard will own 3% of a portion of Corpay's business. That's not 3% of the total business. That's 3% of the cross-border business. Next slide. You can see what attracts me to the company. It's up straight and parallel, and it's had consistent sales and earnings growth for a long period of time. Even the pandemic year of 2020 and maybe 2021 is not as evident in this graph as it is in many of the companies we take a look at. I've been, I think, extremely conservative, moving in my projections for sales growth. I've taken the Corpay sales growth organic number of 10% and used it for historical sales growth. And then I've used the 12%, and I'm going to play the game the way that Value Line plays the game, that as long as they're just talking about a merger or acquisition and not having it impact the numbers, I'm not going to consider it until it does impact the numbers. So I'm looking primarily at organic growth right now on these growth values. Next slide. I'm looking at the evaluation of management, and I know that that says red next to pre-tax profit, but I'm looking at those 5 numbers and I'm saying to myself, you know, I think they're more stable than they are declining. I know that the numbers themselves are going downward, but I think there's a lot of stability in that margin number, and I'm not too concerned about it. That's excellent return on equity, and because of the acquisitive nature of the company, they have historically carried a high amount of debt, and they continue to carry a reasonably high amount of debt. They haven't seemed to have any problem with that debt over many years of their history, and you can see the last 10 years of interest coverage are showing that they've been able to maintain an interest coverage that should keep them out of trouble if there should be some kind of a serious decline in their business. Next slide. I'm using the 5-year averages, or a little bit lower even, to project out into the future. I like that 28. I'm looking at the whole list right there. I could strike the 40, and when I struck the 40, it didn't change much from 28 where it was. So we'll keep the 28 or so as the high PE going forward. I've used 16 as the low PE. It's got down to as low as 13 in the last 5 years. These 2 PE values give me a buy. Next slide. I always use Manifest for validation, and I'm getting a par from Manifest of 16.3%. Value Line is suggesting 3 to 5 year returns somewhere in the 10 to 22% range. 18-month returns somewhere maybe around 25% returns. That's the final paragraph in a brand new Value Line, and the analyst, Mr. Foldesi, seems to think that this is a pretty good company to add to a buy and hold investor's portfolio. I'm not ashamed to admit that I'm a buy and hold investor, so I like what Value Line has to say. And my own SSG, next slide if you would, is right in line with all of those numbers I just talked about. My projected par value, my par value is 15%, maybe going up to as much in the best case scenario of 21%. And therefore, I think that Corpay is an interesting and viable company to add to the Roundtable portfolio. So let's put another $1,000 in for Corpay.
Sounds good. Thank you, Ken. All right, I'm going to just wrap things up with a fairly quick hunting expedition here. Many of you in the audience are familiar with the work we have done with what we're calling the cash flow aristocrats. It's a takeoff on the dividend aristocrats. And we do have a public dashboard that emboldened link at the bottom of the page gets you to all of these. And what you'll be looking at is a listing of companies that have at least 10 or 9 years of increasing cash flow. Okay, so I have gone down this list. You see a couple companies up at the top that have had some disruptions, Lulu being one of them. But I went down the list and I said, I just want to focus in on a little more growth. So Nice came up, Ken's Corpay came up, Texas Roadhouse, which is actually size pick from last month, and Brown & Brown, which was my pick from a couple of months ago. So those are the 4 companies that kind of jump off the page at me a little bit. And these are some pretty formidable companies that have generated very nice long-term returns. It's a nice pool to go shopping in for purchase candidates. So again, I'm focusing on the ones that are a little bit faster growing, that are potentially attractive from a return forecast perspective. Okay. We have selected the company Nice 6 times, and I just thought I would share this. This is the type of thing when Cy was talking about how we've actually made 890 decisions here at the round table. Here are 6 of them. We keep track of every one of those 890 just like this. You have the purchase date and the person, or in this case, the audience, you, the wonderful audience who's really probably taking this presentation in and just can't wait to vote. You can see that the audience has selected Nice a couple of times along with Kim and myself, and it has languished over the last year or so. We did it 6 times during 2024. And like many of the companies that we were talking about a little bit earlier, they just have been a little bit in the doldrums. This company is not new to us. This is just a quick look at what they do. They are a world-class, basically consulting company, consulting and software services company. They're known as a call center. That's the word for customer engagement is the class of business that they're in, but they are a call center, and they also provide financial crime and compliance solutions. What they basically are best known for is being artificial intelligence before it was cool. They have basically been putting and embedding AI, artificial intelligence solutions in their businesses for the better part of 4 decades almost. And that really is kind of amazing, because AI has really gotten only extremely popular in the last 1 to 3 years. So these guys have a really good business model. They have highly talented consultants. They're deployed worldwide. And they have client managers that work on site with all of these companies that they serve. And just a very formidable company over the years. And the fly in the ointment right now is they are located, as it says in that final sentence, in Rina, Israel. That's actually very close to Tel Aviv. And the problems over there with the conflict. Here is a quick look at the company. You'll see why we have liked it many times over. You can see that the sales trajectory is pretty powerful. It's right at that 10% level. You can see that the earnings tracks it pretty closely also. Definitely up straight and parallel. And you see that very powerful cash flow that, again, has been increasing year after year after year, going back for at least as far back as 2015. So that's what puts them on the cash flow aristocrat leaderboard. So you're basically talking about a company growing at approximately 10% with really nice profitability, profit margins in that upper 20s, 28% range that you can see there. The PE is very normal PE of 16. Under those assumptions, you have a projected return based on the current price of somewhere in the neighborhood of 20%. You see the EPS growth forecast, which could be used for a stock selection guide. And then we also look at that projected cash flow growth. What is the slope of that cash flow growth line? That is very consistent with both the sales and the earnings growth forecast. So comfortable with all three. So what's the situation? Well, the bombs going off overhead over in Israel has definitely been a pretty nasty situation. And you can see that in that middle graphic there, anytime we have a company that's firing on all cylinders and the operating results and achievements are continually and consistently going to the upside, but look at that stock price. Has basically been on the opposite trend for the better part of 5 years. Peaked out at $319, almost $320 at the end of 2021. In over the course of the next 3 to 4 years, it has dropped down to, it reached a low of 127. It's currently at 134, so it's very close to that all-time low from this chart in that period. And again, subject it to your own study, but it would be very feasible to end up in that 225 to 335 range that Value Line has offered. That's very consistent with the number that you see here for the 20.8, basically barking at the same tree. So again, the message here is this company continues to fire on all cylinders, even with the armed conflict going on over there, and quite disappointing to hear today that it actually had kicked up again this morning. But their staff is deployed worldwide. Their consultants and their client managers are literally all over the world. So no matter what happens over there, they don't have 100% exposure to the situation at hand. I think that the worrying is overdone. And again, they're firing on all cylinders. So I'd like to close with Pumbaa's Hakuna Matata. No worries. Let the price reflect the operating performance of the company. At some point it will. We basically believe that price follows earnings. At some point that price is going to change trajectory and follow that earnings slope. I think we should be on board for it. Hakuna Matata. Thanks, guys. Ken, I think we're ready for a poll.
Okay, give me just a second here to run that poll, Mark. And we'll ask you to vote if you could possibly. Either we're going to put an extra $1,000 into Corpay or Gentex or to NICE. If you don't like any of those, then vote none of the above. We have a nice audience here. I've given a boost to one of the stocks now. We have a very large audience here this evening. So I'd love to see us get up to around 80 or 90% voting if we possibly could.
Ken, if I get less than 6%, I'm moving to South America.
Okay, all right. Well, I'm getting a note from Roger out in Indiana that's saying that he has to vote for yours because he just bought it himself. Okay?
Oh, there we go. Thank you, Roger.
So,
go Hoosiers. How about those Hoosiers? Hottest football team in America.
Well, there's a couple of Buckeyes that might argue with that, but
yeah, but they're always this is
we'll have to play each other before we decide who's the hottest team.
It's
okay,
a new experience for Hoosiers.
Well, I've learned to be a much more forward with my football philosophy since I've lived in Michigan here, Mark. So we have 80% plus voting. We'd love to get it up to 90. I'm going to kind of count backwards to about 15. And if you haven't voted, folks, it doesn't cost you anything. Just pick one and help us decide which company belongs with an extra $1,000 in the round table here. So I'm counting backwards. We just hit 85. Can we squeeze a few more votes out of you? If not, I'm going to close the poll. Here's the poll, and I'm going to share the results. And Corpay ran away with a majority tonight, Mark.
Go ahead.
We have Corpay at 51% and Nice at 29%. You beat your 6 mark. And Gentex at 17%. We have 3% of you that didn't like any of them. And we'd like to invite any of you folks in the 3% to present next month, okay?
Some people.
All right. So I'm going to hide this right now, Mark, and you can go on to our last few slides, if you would.
Okay, are we back showing my screen? I have a couple notes.
I think so.
Okay.
Yep.
All right. Quick reminder that we do archive all of our roundtables at YouTube. If you go to YouTube and you just simply search for Roundtable Manifest Investing or Better Investing, you will be taken to this page, and you can track down the old roundtables. That session in I guess I don't have it on here. The session that we did a month ago has been very popular, but you can see that there's a couple roundtables featured on this slide. Coming attractions? Go ahead, Ken.
Well, we're going to be doing Best Small Companies on November 1st. That's Saturday. It'll be at 10 o'clock in the morning. If you need to register, either drop Mark a note and he'll send you a link, or go to manifestinvesting.com under events. You don't even have to be a subscriber to Manifest. If you just go to the website and you look before you even try to sign in, you'll see an events tab and you can register right then. That's our Best Small Companies, 10 o'clock Saturday. Our November roundtable, because of Thanksgiving, will be on December 2nd. And then our December roundtable, because of the holidays, will be on January 6th. So November's happening the first week in December, and December's happening the first week in January. We will have a roundtable the last Tuesday in January as well. So we'll be back on schedule once 2026 gets underway. Don't forget that Mark and I both, as well as Cy, will be at the National Convention, fondly known as BINC. And BINC will be April 23rd through 26th. That's a Thursday through a Sunday morning. And it'll be in Chicago this year. It'll be live. Join your friends. Have a good time. And come to some pretty darn great classes. If you're a beginner especially, the beginners sessions are extremely popular and will get you a running start on how to use our tools and what you think about our methods, the better investing stock methods. So that's April 23rd through 26th in Chicago. And I think that we're progressing pretty well after that then, Mark. So I don't have anything else to add. Again, Cy, I want to thank you so much for being as loyal as you've been and helping us out. Mark, that goes for you as well. Mark has been here every single roundtable, and we couldn't be doing this without him. And I'd like to thank you in the audience for coming and helping make this a pleasurable experience for all three of us.
You're very welcome, Ken, and everybody. Before you sign off, let me just make a shameless self-plug to encourage everyone to make this stock study Saturday after you do the small stock program at 10 o'clock Eastern. The Puget Sound chapter has has 3 sessions in their investment education conference that starts, I believe, at 11:45 Eastern. And the last one of those at 2:15 Eastern is Cy Lynch When to Sell. And I think another guest night, Kevin Galogly, starts off at that 11:15 time. So you've got some manifest stuff going on after your small company.
Yeah,
Those
session.
should,
And that is a
those should dovetail really well with each other, right? So
Yeah.
and folks, if you need to register for those, that's the Puget Sound chapter out in near Seattle, Washington. And if you go to the Better Investing website, up in the upper right-hand corner, look for community, look for chapters, and then look for Puget Sound chapters, and you'll be able to put a link together for those events. I don't think there's any charge associated with any of them either.
That's correct. It's a they accept donations, but no charge.
Okay. So again, thank you, gentlemen, for being here this evening. Thank you, audience, for everything that you provide to us, which is a great group of people to talk to and be community with. And we'll see you all again at the round table on December 2nd. Happy Halloween, everybody. Grab a grandchild or grab a child and go out and do some trick-or-treating, okay? Good night, everybody.
Thanks. Good night.